welcome to NDTV Profit. A very good morning to all the viewers you're watching. Know your company, that is KYC. I'm Hiral Dadia. What is on our radar today? We have Orient Technologies. Yes, a small cap company, but lots to know about this one, taking into consideration the kind of recent moves the company has made. Now let's understand. Firstly, the impact of high receivables on cash flows, is that a concern right now for them? Moving on, the second aspect that we're going to consider over here is taking the order book into consideration, which stands at around 414 odd crores or little more. Does that mean the FY26 revenue will remain the same? And the potential revenue that the company is looking to see from the security ops center segment from a business side. Moving on, if you have to look at this, security operations center, how quickly can this business clock a 20% margin? Because that's the guidance that the street is working with. And from a 3-year view, what does the top line, margin and recurring revenue tell you from here on if you have to look at Orient Technologies from a growth perspective? What is the kind of export opportunity that Orient Technologies is actually sitting on as well? And if you have to look at the third quarter, what are the factors that will lead to the margin expansion that could come in Q3? These are a few of the questions that we are talking about with regards to where Know Your Company goes and on our Orient Technologies. But let's shift focus to tell you more about the company as well. Firstly, it's an Indian IT company who's into transformation and an infrastructure partner as well. It offers multiple facets like IT, cloud, artificial intelligence, security and digital services, and they mainly focus on recurring as well as annuity services. So it is not a one-time sale. So stickiness with regards to clients becomes absolutely important when you talk about Orient Technologies. They are headquartered in Mumbai. The employee count is around 1,600 employees, and they have a pan-India presence as well. If you talk about their product and solutions, you're talking about IT infrastructure, which comprises of data centers. That is one of the hot topics, and that's one of the reasons as well why we've called the company right now, because one of the brokerage reports did note that there is a 5 times growth that could be expected over there. Servers, end users, devices, as well as networks is what they deal with in terms of IT infrastructure. When you talk about device as a service, which is DaaS, they do give out devices on monthly rentals as well. In terms of cloud and DevOps, they look at management, optimization across AWS and Azure. So this is, Amazon AWS. Moving on, cybersecurity, they're talking about endpoint security, managed security operation centers and threat monitoring as well. In terms of managed services, you're talking about, remote facility management as well as infra managed services as well. And in terms of digital transformation, analytics, artificial intelligence, automation, custom apps comes at play. The new aspects they were looking at is GPU and AI hosting, which is partnered with AWS for India AI mission. So this is what they're looking at. But let's quickly look at the segmental revenue mix as well for the company. Around 60% of the revenues come in from IT infrastructure services versus 40% that comes in from app and IT infra as well. So that's in terms of your FY25 breakup. And your cloud and data, that is actually growing faster. If you look at the next one in terms of the segment, it's a 30% plus compounded growth that you're looking at. ITES, a very stable business that they have on that front. Order book, crucial for visibility for them because their total order book is at around 414 odd crores right now. And they've said that this will be billed over FY26. So that's the key question, that is this what is going to translate into revenues in terms of FY26 as well for the company. And multi-year service contracts is what they look at for public sector, enterprises, and BFSI, cloud and DaaS. So that's everything that you need to know about the company. But let's quickly look at all your rating parameters from here on. From your income statement check to balance sheet, cash flow, return ratios. You're talking also with regards to shareholding patterns, street credentials, street coverage, and the valuation picture and outlook. These are the ones that we will be considering with regards to where Orient Technologies is concerned. But let's dissect the first one. Income statement. Let's pull up that one on the screens and you'll see what's happening with the income statement from a revenue. A 22% compounded growth is what you've seen from a 3-year perspective. And the margins, in fact, have declined. So that is going to be crucial. The profit number has seen a compounded growth of around 15% and EBIT is around 12%. So your EBIT and profitability, the growth is slightly lower as compared to your top line, and hence we've given it a sideways, that is a neutral rating with regards to where income statement goes. Moving on, if you have to look at the same one in terms of the Q1 FY26 performance as well, if we can get that one, because that will give you the sequential and the year-on-year growth. Revenues have seen a decline sequentially, EBIT has gone down, margins have declined, and your profit number has also declined. But year-on-year, a marginal growth that has come in on that front. And if you have to talk about the margin trajectory for the company, from a 9.4% that they were in FY22, it's been declining and it's come down to 6.2% in the first quarter of FY26, and that is something which is absolutely concerning. So yes, a sideways, that is a neutral rating. In terms of the balance sheet check, let's quickly look at the equity and the cash and bank. If you see in terms of the equity, a strong growth that is coming in from 18 crores to 42 crores over a period of 3 years. The cash has been increasing as well substantially from a two-digit number of 20 odd crores in FY23. A similar number in terms of FY24, it's actually grown 5 to 6 times to 116 odd crores. So that is one of the key positives. The borrowings have gone down substantially as well. And if you talk about the other equity, that has nearly tripled in 3 years. So hence a thumbs up, because the balance sheet is looking absolutely strong when it comes to Orient Technologies as well. Talking about the cash flow matrix from here on. Now, what is happening over here is, if you see the cash flow, let's quickly look at the operating cash flow. It's actually gone into negative, on the back of which, if you see the profitability, when they've put it, added a 50 crores in FY25, the cash flow from operations to profit, that is a negative number. That's a negative 22%. The net cash flows have actually come in at 95 odd crores. And it's a very no trend line kind of a picture when it comes to cash flows. There is no stability, there is no sustainability, it seems. And that's the reason why a thumbs down coming in with regards to cash flows go. Because one, your operating cash flows is getting into a negative number, into a loss, which is a concerning area when you talk about this matrix, and hence a thumbs down. Let's quickly look at the return ratios as well. Now, return ratios become absolutely important from an investor perspective. And there you go. They actually started at a high of 55. You're looking at 27% now. So there is that stability which probably will start emerging from here on, is what the street is anticipating, and hence a thumbs up, because in terms of your return to capital employed, I mean, a 45 to 41% kind of a number, not very sustainable, but from here on, there could be some bit of sustenance that could be coming in as well. Let's quickly look at the shareholding pattern now. If you talk about promoters, they've remained absolutely stable in terms of their stake. FIs, in fact, have actually gone ahead and reduced stake in the company. DIs have been absolutely absent. The public free float has increased from 21% to 26%. So there is some bit of retail participation that has gone up with regards to where Orient Technologies go, and that's the reason why a thumbs up giving in there. But the promoters have remained absolutely stable. There is no institutional investor which is putting their bets on Orient Technologies. But because the retail participation is high, we've given it a thumbs up, not considering the FIs and DIIs currently on this one. Moving on. The next parameter that we're looking at is the shareholding we already looked at, the street credentials from here on. Again, sideways, that's a neutral rating, because if you have to look at since listing, which is in August 24 to now, the returns have varied in that range of almost 7% to 27%. So since listing, no major gains coming in for someone who looked at the stock or entered the company at the IPO time. The returns actually started coming in only on a YTD basis, where it's actually grown 27%. So, a neutral rating there, not a loss to the investors, still making a profit in terms of their investments on the stock. So hence a neutral rating there. And when you talk about valuations, now the most expensive, or maybe the second most expensive, if you have to look at peers, from Orient Technologies, Dynacons and Allied Digital, these three are the competitors. The least expensive right now, the cheaper one is Dynacons, which is around 17.4 times. But The most expensive is Allied Digital, which is at 35.5 times. Orient Technologies fits in somewhere in between at 27.5 times the current PE. So in terms of the current price to earnings, we've given it a neutral rating because it's on number 2 out of the 3. And very lastly, the outlook seems to be also very neutral right now because the aspiration of the company is to be in the top 5 system integrators from here on. Whether they will be able to make it to that list or not is the question we need to check. Their focus is mainly on recurring revenue and cybersecurity. So the stickiness with regards to clients becomes absolutely important. If they are not able to get that stickiness, then the business could go sideways as well. And the total order book currently is around 414 odd crores, and the Q1 order intake was under 105 odd crores. They've also mentioned that probably the margins could remain under pressure in the second quarter. And as we know, the margins over the last couple of years have been on a declining trend. So that has been a concerning area as well for Orient Technologies. And the reason why we are seeing that lag in terms of margins is because the investment that they're making in employees, they've built a base of almost 1,600 odd employees so far. And this is coming in at a time where you're seeing layoffs happening in the IT industry. Secondly, they're building out the security operations centers as well. So that is what is putting pressure on the margins. And the revenues from this business are yet to come in. So till the time the revenues don't come in, the pressure in terms of margins is expected to continue as well. And the anticipation is over 20% margin with regards to the security operations center business. And that is a tall ask right now. How achievable is that going to be? How sustainable that is going to be? And how fast that is going to come in is what we need to see. Very lastly, the device as a service is also a core, and that is an innovative offering that the company has. And in terms of their midterm roadmap, that actually includes expanding services beyond India. So they're looking to, look at other countries as well. So that export part of the business becomes important as well. And very lastly, that targeting APAC and Middle Eastern markets. And the timeline that they've given for these two markets is 3 years. So within 3 years, what will their export opportunity look like? How much will that contribute to their top line? How much will it aid margins? And profitability is the key from here on. Let's quickly look at all the ratings now. From the first 4, you have balance sheet and return ratios, which are a thumbs up. Income statement is neutral and cash flow is a negative. So that's a down one coming in there. If you look at the other set of ratings, again, 3 sideways, which is 3 neutral. Street cred, valuations and outlook is pretty neutral right now because they yet have to perform to get there. And your shareholding is a thumbs up only because your promoters have remained steady and the retail participation has increased. Overall, a 5 on 8 rating is what we've given Orient Technologies, which is still on the higher side. But what from here on? Joining us on the show to discuss more, we have Mr. Ajay Sawant, Chairman and Managing Director at Orient Technologies. Ajay, welcome to the show and a pleasure to speak to you at NDTV Profit. My first question coming to you is, since listing to now, a lot of metrics where we've seen ups and downs that have come in. My first question is in terms of FY26. Now, your revenue expectation to match the order book is around 414 odd crores. Is that what you're considering that will be the top line and what you're targeting, or is there a possibility that could overshoot?
So first of all, thank you, Hiral, for having me on the show. Coming back to your question, I'm very much eager to tell you that yes, we have been doing really well in terms of top line. Quarter on quarter, we are increasing our top line, and last year revenue has been grown more than 40%. Yes, definitely there is a pressure on the bottom line and the cash flow. Okay, these two parameters, yes, we are working on this. Bottom line parameters, because of our talent acquisition, which is we are doing it in the currently when the others are actually asking people to leave the organization, we are just saying that we are acquiring those talents. We are getting into the talents because we are getting into the new space of cybersecurity as well as in the space of managed services. So our focus is increasing our services revenue, which is a healthy bottom line driven margins. And currently, as you see that once the services keeps on growing, we will increase our bottom line as well. So that's the plan that we have.
So if you have to look at the revenue, it's heavily concentrated in terms of where the domestic markets go. You have an ambition to move into APAC and Middle East as well, but that outlook is over the next 3 years. From here on, taking the reliance that you have and the way the business model is that you need sticky clients because of the recurring revenue that is needed. What is the client profile that you're sitting on right now? What is that average contract size that you have with these clients and the tenure?
Okay, so here currently, if you see, our entire customer base is concentrated mainly into the mid-market segment. And if you see, being in Mumbai, we have a huge BFSI segment as our customer base. Second is government and public sector units, which is where we are concentrating on our businesses. And we are into the basically a digital transformation and the services businesses. So we work with the customers on the digital transformation, where currently the AI becomes a huge momentum for all of us, and that's a great lever to work on in the infrastructure space as well as in the application development space, and we are trying to get into the services space from that.
So, but Ajay, you know, your concentration with regards to where I think the top 10 clients go, that reliance is absolutely heavy, and a significant portion of your revenue comes in from your top 10 customers. Loss of any of these key clients could actually have a substantial adverse effect on your financial performance. How are you hedging that aspect?
Okay, so these customers are basically having an annual recurring revenue, and we have signed a contract with them for 3 to 5 years. So because of that ARR revenue for next 3 to 5 years, the stickiness is there with the customer, and that is where we are not so much worried on those top 10 customers or top 30 customers, which are contributing to a good amount of our business. So what we are very commonly saying within the organization is that keep on increasing this ARR revenue, and the base will keep on increasing.
Then Ajay, what about the risk with government contracts? Because they are typically awarded through a tender process where it comes from lowest bidder, and that's what is often chosen. So if that is the case, one, you already have a risk of whether you will get the tender or not. And secondly, once you get the tender, it's a low margin business as well when it comes to with the government. Obviously, you're not going to be able to scale to the margin profile that you want to. How do you play that aspect?
So not all the government and PSU nowadays work only on the L1 basis. Today, the customer is wise enough to understand T1 and L1 basis. So technology perspective, they give 70% rating, and commercially they give 30% rating. And that's how we pick up and choose only those deals where technologically we are superseding our competition, and commercially also we are making sure that we are having enough EBITDA on the paper. So we make sure that on the balance sheet we are having a good margins, okay, through the commercials. But technically is which is our strength. Our organization is more technically competent enough, and that is what we leverage in the market.
So let me ask you then, the high receivables that you have right now, are you seeing any impact that could have on the cash flows? Because cash flows are already depleting when you talk about the operational cash flow. So what is that target number you have for FY26? And by when do you see cash flows turning positive?
Fantastic. So yes, barring last year, if you would have observed our balance sheet for last 5 to 7 years, we are always cash positive. Only FY 25 where we are showing that the cash flow is negative 11 crore. Otherwise, most of the year we are always cash positive, and it's a matter of time. Okay, we are working on this. Within next couple of quarters, we should be coming back as a cash positive once again, because there is a huge outstanding which is there because of certain projects which got prolonged from the customer side, and that is where we couldn't able to recover our investment. But it's a matter of time.
What is the revenue number that you're planning or you have in mind for FY26? 27 and 28. The reason I ask for 3 years is because your security ops centers will also come at play. So what is that looking like?
So generally we do not predict we do not give the predictions on the future numbers. But what I can tell you that next 3 years there is definitely a plan growth which is there on the card through various of our offerings, which is like DaaS, SOC or cloud. which will be in the tune of 30% upwards.
30% of upwards growth is what you're seeing in revenue. What's the
Exactly.
potential revenue you're seeing from the security operations center business? That's one. And how quickly will this business clock upwards of 20% margin? Because that's the outlook that you've given as well.
Sure. So our SOC getting operational in the mid of Q3, and in a full 1 year of operations, you will see a good number coming in from the SOC operations, whereby we are
Right. What
expecting
would
a
that number
margin
look
of
like?
currently, as I said, that we do not predict the futuristic number, or we
I know,
do not.
Ajay, but a ballpark in terms of the investments that you've already made to compromise on the margins to actually get the SOC business up and running. I'm sure there will be some visibility with regards to what the anticipation could be of the revenue potential.
So
So if you
first
could,
full year concentration, if I see, it will be a single percentage digit of our overall revenue.
okay.
Okay. But second and third year, it will be a higher double digit percentage of our overall
Got it.
revenue. That's what I can tell you.
That helps. And how soon will you see the business clocking an upwards of 20% margin?
So by calendar year FY26, calendar year 26, I'm talking about, we should able to get you that very sure.
Okay. And what's the kind of export opportunity that you're looking at? Because you've given an outlook that in the next 3 years, you will be looking at Middle East and APAC as well. Any regions that you've started targeting, and how much in the next 3 years would export as a percentage of your revenues contribute?
So we have not yet planned for our international business, because this is the revenue which we are targeting in the 2 to 3 years down the line. So probably the first and foremost region that we'll concentrate is into the UAE market, because that's a booming market, and Africa followed by that. So EMEA market overall looks really good. Okay, and we'll be getting into the MEA market, which is the Middle East and Africa, which we will be targeting in next 2 to 3 years. But currently, we are just evaluating that market. We are studying that market, but there is no plan, which is concrete plan I can share with you right now.
When it comes to your order book as well, as you mentioned, the order book is good. Receivables are pretty strong because some of the projects got delayed as well. So what is the visibility that you have in terms of FY26 from an execution perspective? So if your order book is standing at around 400 or upwards of 400 odd crores currently, how much visibility you have in terms of execution on that? And in addition, any orders that could be coming in to get added to your order book in the next couple of months?
So 400 plus crore is already there,
Correct.
which is completely visible and will be billable. It's 100% billable. So
Will
this
it be
400 crore,
receivable?
no, this
Will
is
you?
billable order book. This total order book which you are showing on the screen at 440 crore, this is all billable, which will be in Q3 and Q4, it will get billed for sure. Okay. On the front that we are expecting another, couple of hundred orders, crore orders, which will come. So overall, H2 of FY26 will be to the tune of around 600 crore.
Okay. And how much out of this billable order book you think will translate into receivables? Because receivables is the pressure point right now. What is that credit cycle period that you actually have versus what it has come down to right now?
So currently our DSO is in the tune of 100 plus days,
Okay.
which we want to bring it down to around 75. Okay, as per industry standard, 75 is average credit days, which is been offered to the customers in our industry.
Okay. In terms of the receivables, do you think anything that could actually become a bad debt?
So in our last 10 years record, which we have seen, 0.5% of our revenue will become a bad debt if at all we are not able to get into a right perspective. But now I don't see any red light coming from the finance on any of such outstanding, which I can talk about.
Okay. Very lastly, in terms of your ROCE, there were times when you were at a high of almost 55%, came down to your 40s. Now I think it's in your 20s. Where do you see it stabilizing, and what's that
I
sustainable
think
number?
we are already bottomed up. So now from here onwards, see the IPO money which is coming in, which has bring down my ROC drastically down. Okay, from 55 to 27. Okay, I don't think there is a scope for further going down. It will now come up only.
Okay. And my last question to you is, where do you see your margins settling in currently and stabilizing? Because again, that is also slightly on the downward trajectory.
Yeah. So currently we are into the 6 to 7% of EBITDA margin, which we want to grow back to around 9 to 10% in couple of years. Once we start getting into the SOC revenue, DAS revenue, which will start flowing in now. Okay. And I'm sure it's a matter of time. Within 3 4 quarters, we should come back to around 8%, and next 3 4 quarters will touch down between 9 to 10%.
Okay, so 9 to 10% is what you should be watching out for from here on. But thank you, Ajay, so much for joining us on the show at NDTV Profit. A pleasure to speak to you, as always. So that was the management of Orient Technologies. Here we are talking about something which has been unsustainable, probably receivables were a concern, and now you have some bit of an idea of what to expect going ahead from a top-line perspective, the stickiness that could come in from a recurring revenue space, and the SOC business, which will start to play up, and upwards of 20% kind of margins is what they are targeting as well on this aspect. But completely out of time. With that, it's a wrap on this edition of Know Your Company. Lots more lined up on the other side. Please stay tuned to NDTV Profit.